I am basically just about to get started. Are you wanting to come in over the telephone, or have you been able to get in online with regards to actually being able to view the presentation as well?
No, it wouldn't download whatever I needed, so I'm just going to listen on the phone.
Okay, no worries. Well, we're ready to go, so thanks very much for your time. What I'm going to do basically is, if you wouldn't mind also bearing with me a little bit. Obviously, this is quite a lot of new technology, and there's things that are working and breaking as we speak. But anyway, I think the most important thing today is to look at and to understand what is happening in the UK market. For the purposes of those of you that haven't met me, I am a South African, Durban-born South African, but I lived in London for 9 years and now live in Johannesburg. I've got a business in London and I regularly travel there. And really what I wanted to do today was to try and explain what's happening in the UK market so that you can understand it, and really to actually answer that question between crisis and opportunity. You know, is it a crisis or is there actually opportunity in amongst what's actually going on? So when one looks at it, there is a lot of opportunity at the moment in the market. So let's crack on and get to answer some of those questions basically. Right, just so that for those of you that are online, you'll see that you've got a screen, so you can see the PowerPoint screen, and then there is some functionality. You can raise your hand, you can ask questions. For those of you that are on the telephone, obviously, if you want to ask questions, just fire away, and we can run through it. I will obviously run through it and hopefully be able to answer most of your questions, and certainly by the end of it, I'm sure we would have answered all of your questions. So let's get going. I mean, with regards to what you're looking at, there's a hell of a lot of hype and there certainly has been for the last 6, even nearly 12 months. The press in the UK, they love to talk the market either up or down. It's either booming or busting all the time. And for those of you, you can actually see it was one of the articles I got out of the Daily Express when I was there last week. Tremendous amount of articles as to what's happening in the property market there. But, you know, the underlying thing is that for me, one of the biggest advantages is actually taking advantage of the opportunity. And the last crash that happened in the UK market was in 1991, and I believe that now is the best time to actually be looking at the market since 1991, and I'm going to explain to you the reasons for that. The first thing that I believe with regards to property, and one of the most essential things, is actually timing. And, you know, just to give you some little stats, Bill Gates earns $6,133 per second. You know, a jiffy is a unit of time. It's 1/100th of a second. You know, in most advertisements in newspapers, you actually display the time as 10 past 10. And the property market in the UK doubles every 7 years. So statistically, over the last 50 years, it has doubled every 7 years. And one needs to understand the importance of timing, particularly with regards to the market at the moment and getting into it. The other thing from a South African perspective is that the rand to the US dollar, the rand to the pound, has devalued about 5% every single year statistically for the last 15 years. And while inflation in our country is around sort of 8, 9, 10%, and in those countries is around sort of 2, 3, 4%, while there's that gap of 5%, it's economic fact that over time the rand will continue to devalue. And, you know, if you look at the graphs here, they speak for themselves. This is from Yahoo Finance, but if you take the last 5 years, the graph just shows a one-way trend in terms of the rand and what's actually happening. There you've got the rand to the pound, you've got the rand to the Aussie dollar, you've even got the rand to the Kenyan shilling, and effectively it shows you, you know, a one-way trend. But, you know, for me, there's one word in the Chinese language, and there's only one word for crisis and for opportunity. And wherever there's a crisis, there's also an opportunity. When you look at this graph, and I will actually send you the presentation or by email if you're interested, for the guys that are on the telephone. But what you're looking at when you take the currency, the green line is the pound to the US dollar, the blue line is the Aussie dollar to the US dollar, and the red line is the rand. And I think the most important thing, and I've done this over the last the last 12 months, but you'll actually see that the pound has devalued by around 19%, the Aussie dollar around 17%, and the rand has only devalued by around 6%. So right now the rand is actually very strong against the pound and the Australian dollar and obviously the US dollar. And what one needs to understand is that there's a huge opportunity with regards to actually taking advantage of not only low asset values overseas, but also the very strong rand and being able to get into them. There's a saying that Napoleon said, the right information at the right time is the 9/10 of any battle. And what I'm basically trying to do here is to give you an overview of what's actually happening in the market. So when one looks at the market as it stands, I got all the stats and figures yesterday. There's 7 major indices in the UK. The 2 of them that I use most is the Financial Times Index and the Nationwide Index. Now, to explain the two, the Financial Times Index takes all property across the UK. So it takes mortgage property, it takes property that's owned outright, cash, etc. The Nationwide Index, obviously, they're one of the biggest mortgage providers in the UK, but they obviously only take into account mortgage properties. And to give you an idea, the amount of mortgage properties in the UK is actually less than 50%. So one needs to take into account both of them to understand exactly what's happening. According to the Financial Times Index, the average cost of a property in the UK now is around £197,000. The change in the last month was down 0.7%, but it's the 5th month in a row where it's actually been less than 1%. And the change from peak to trough is now at 14.1%. So the property market has lost around 14%. The Nationwide Index has the average cost at £154,000, and in May it actually went up by 1.2%. And the change in the last year is down by 11.3%, but it's already improving from the high or the worst case scenario, which in April was around 15%. So I mean, I think what one looks at, if you're looking at this overall index, basically 2 things are very important. One is that the property market hasn't necessarily stopped dropping, but the rate of decline is definitely slowing, and we're tending towards getting to the bottom, and it's definitely slowing down. And the second thing is that conservatively, taking both indices into account, you can work on the fact that the property market at most has lost around 15%. Now, what's important with that is that if you look at this graph here, you can actually see this monthly change. And the worst time in the UK property market in the last 12 months was actually in November 2008, when the market lost 2.2% in 1 month. From then, it's actually been decreasing, and you'll see there February, March, April, May, the rate of decline is actually decreasing every month. And that, for me, is the most important bit here. Because when I'm a big believer you can only ever call the bottom of the market in hindsight. And I think the important thing here is trying to understand the opportunities in amongst the situation. Now, the 2 biggest things that cause the property market to collapse, firstly is unemployment, and secondly is interest rates. So when we look at the GDP in 2007, so the economic growth was 3% in the UK. In 2008, it was 1.5%. In 2007, there were 29.4 million people in employment. It was the highest number of people employed in the UK ever. But since then, in the last 12 months, we're very aware, they've actually had the worst recession since the Second World War. The economy shrank by 1.9% in the first quarter of this year, and it's the most it's shrunk since 1979. Unemployment rate rose to 7.1%, which is up by 0.8%, and then effectively the number of people in employment now is 29.2 million. So what it basically means is that 295,000 people over the last 12 months have lost their jobs, and that for me is one of the most critical factors that one needs to understand, and actually was the reason I flew to London 2 weeks ago, to go and understand what was happening with regards to the retrenchments and what impact that was having on the rental market, and I'm going to go through that in some detail. But the Bank of England has come back, and they have a significant plan in place to help both the economy and the unemployment. And first and foremost, they're spending £125 billion to re-inject that into the economy, and there's a lot of plans in place with regards to the unemployment. But the second thing, and I think the one that's even more important, is the interest rates. Because in 2007, the interest rates were at 5.25%. They're now at 0.5%. And when you look at this graph here, you can see the Bank of England rate over the last 25 years. You can see where it's peaked in different times. So there in 1979, actually, which I mentioned, where the economy was in trouble, it peaked, and again in 1991. But you can see the trend with it sitting now where it is, and what an impact it's had to the affordability to the man in the street. And I think the most important thing is that the last time the property market collapsed was in 1991, which is around this period here. But what happened in that market was a double whammy. You had both the unemployment and you had high interest rates, and people just could not afford their properties, and that was the issue. So what you've basically got now, and what is good is that, yes, there are unemployment concerns, but most importantly, the interest rate has come down so dramatically. When one looks at this next graph, if you want to understand why the UK market and why there's still problems in the UK housing market, this graph basically explains it. And what it basically shows you is that America and the UK have had dramatic, the Bank of England has done dramatic things in terms of dropping interest rates. I mean, as I said, they've gone from 5.25 to 0.5%. The problem you've got is that the banks are not passing that on to the man in the street. In America, it's dire in terms of the banks actually passing it on, and it's the same in the UK. And because of that, the man in the street has not seen the affordability gains. And also because of that, because they're lending at such low loan to values, the man in the street, even if he wants to buy a property, has not been able to go and buy a property. And that is what has caused the market to be in this downward spiral, where because people can't buy property and therefore prices have gone down. When you look at this graph, you can see Australia, on the other hand, they've had the complete opposite, where the Australian Reserve Bank has dropped the interest rates dramatically, actually from 8.75 to 3.25, which is about a 64% drop. But the most important thing is that the banks in Australia have passed that on to the man in the street. And it's the reason that the Australian market is the most advanced first world economy property market in terms of getting to the recovery stage. This next graph actually explains what I mean, and it's actually the transactions over the last 5 years in terms of, and you can see there that generally it was averaging around 100,000 transactions per month, and now they're down somewhere around the 30,000 mark. You can see from the graph, even though it's a very long way down, that the transactions have actually started to improve over the last 3 months, and there are more people purchasing. But the biggest thing that is constraining this market at the moment is that people can't get access to finance, and yet foreigners have always been able to get 70% financing and can still get 70% financing. It's the man in the street that used to be able to get 90, 95% and can now only get 75, 80%. And that's the problem, because they don't have the money for the deposits to be able to finance it. And you can see from this next graph what an impact it's had. You can see there in terms of mortgage approvals and how dramatically they've actually dropped off in the last 6 to 12 months. The mortgage approvals are actually the lowest in 9 years, and they're 30% of where they were in 2007. RICS, which is the Royal Institute of Chartered Surveyors, says it's the lowest level of sales in 30 years, and it's only 17% the volume of 2007. Now, when one actually looks at mortgage approvals, in November 2008, which was the lowest point of the market, there were 27,000 approvals. In March, there were 40,000. In April, so effectively the last statistic was 43,000. So it is definitely recovering, but you need to understand that the average between 1993 to 2007 was actually 98,000. So it's got a hell of a long way to go in terms of the recovery. But, as much as this is a problem, it's also a huge, huge opportunity, because there's a hell of a lot of motivated sellers that really want to sell their properties, but they've got very few buyers, and it puts you in a fantastic negotiating position in terms of getting good property. And when the market recovers, when the banks start lending, then the market will turn, and it will turn quickly because the demand is there, and you'll see that now from the fundamentals. In terms of the affordability, the big problem you had in 1991, when the property market was the last time the property market dropped, was that the affordability, actually with the interest rates sitting at 15%, it was 50 to 60% of people's monthly take-home. The national average is 38%, and even at the peak of 2007, the affordability was at 32%. So what I'm basically trying to say here from an affordability point of view is it's the complete opposite of what happened in 1991. And with interest rates now down at 0.5%, it certainly from an affordability point of view has really impacted the man in the street. The most important thing to take into account, though, is the supply and demand, and the distinct difference that you've got in the UK versus America. In the US, they basically got about 1 million homes where the supply has outstripped the demand. So the only way to get it back into equilibrium is actually to get the supply to drop down to cater with regards to what the demand is looking for. The UK is the complete opposite. The population is expected to increase by around 10%, or 4.4 million people by 2021. Household sizes are also dropping. And what this basically means is that they need roughly 208,000 houses per year. Now, the average over the last 5 years has been 170,000 homes. So they're about 40,000 homes short, or 15% every single year. Now, even now, in terms of this whole situation and what's happened with the property market, when I was there 2 weeks ago, there were huge reports in the newspaper about the massive problems with regards to supply of housing. And the government understands these problems. They've basically come out with a housing white paper where they've said they're going to up the number of properties that are actually delivered to the market every year to 240,000 homes by 2016, which is roughly a 30% increase. Gordon Brown, the Prime Minister, has promised an additional 24% spending. And yet, there's a double whammy. They've got the complete opposite. This year, they expected to only bring 60,000 houses to the market. So, there's a big discrepancy between supply and demand. And as a property investor, you'll understand that that is one of the most fundamental things in terms of understanding the market in the medium to long term with regards to growth. In terms of strategies, one thing that's very important is, understanding different strategies. And what I always ask people is London versus the rest of the country. When you look at it, the bottom line is London has more growth and it's got more tenants. And the second thing is, I heard a report on CNN last year that I loved where it said, New York is the center of the Western world and London is the center of the rest of the world. And with what's happening in China and India and the East, London really has become the center of the world and really is now certainly the financial capital of Europe, but arguably the financial capital of the world. You'll see from this graph, if you take the last 35 years, London has actually outperformed with regards to capital growth anywhere else in the UK. So in terms of the growth perspective, that's important. The second thing that you can take into account in London is that you can break London property down into primary areas, into secondary areas, and into tertiary areas. Now, the primary areas are the very well area, the areas that you've heard of, the Chelseas, the Kensingtons. The secondary areas, the ones on the graph here, Kennington, Whitechapel, but it's areas like the Wimbledons, the Earlsfields, those sort of secondary areas close to the good areas. And then the tertiary areas are the Lewishams, the Brixtons, etc. And what you'll see statistically over the last 35 years is that it's the secondary areas that have outperformed any of the other areas. And those are the areas which we, from an IPS perspective, focus on. This picture here that you've got on the TV screen is actually of Canary Wharf. You can see the towers there of Canary Wharf. This is a classic example of a primary area because dead in the heart of Canary Wharf, right there, you're looking at about £800 to £1,000 per square foot, which to put into rand terms is about 130,000 rand a square meter. But a secondary area, this area down the bottom here is called Greenwich Peninsula. It's a brand new development. It's having a huge infrastructure. It's having over £10 billion worth of investment in terms of retail, schools, shops, hospitals, restaurants, places of work, and residential. But the prices there are £496. And what you're looking at is that it's literally one tube stop on the new Jubilee line. From there, that's the tube station through to Canary Wharf. And this is a prime example of one of those secondary areas, very close to a primary area, but where one can expect better growth and better rental returns, better yields. In terms of the tenant demand, London completely outstrips anywhere else in the country. Do you know, when one looks at this graph, and it's not just the British, you've got the Aussies, the Kiwis, the South Africans. I mean, there's a statistic that something in the region of 1.3 million South Africans live in the UK, of which 750,000 live in London. 1 in 11 Londoners is a South African, and we're the biggest ethnic community after the British in London. Now, what is important there is that they all are generally young professionals, and they can't afford to buy property. They're generally quite transient, and so they don't want to buy property anyway, and it provides a fantastic rental solution, along with all the corporates, the Americans that are over there with regards to finance. And as I say, I will go through the retrenchments and the investment. Some things in terms of when people say to me, what's going to happen next? Warren Buffett said, I never have the faintest idea what the stock market is going to do in the next 6 months, the next year, or the next 2. Clem Sunter said, when someone asked him with regards to the gold price, he said it will go up and it will go down, but not necessarily in that order. And what I'm basically just trying to show you, and when one looks at this graph, is that a lot of people in a downturn tend to focus just on that period. And what I think is very important is that you need to understand the fundamentals and understand that when there's a downturn, there's also massive opportunity. And if you invest right, you can really set yourself up right for the long term. And to give you a personal example of that, that's a picture of my first house that I actually bought in London in 2002. Now, at the time, we look back now and it was just another year. But at the time, all my friends said that I was absolutely mad We just had September the 11th. Inflation prices were, were going up. Oil prices were going up. Interest rates were expected to go up, and they were expecting big problems in the property market. And yet I bought that house, and I renovated it, and I stuck 5 South Africans in it, and my rent covered my mortgage. And I said to my friends, I'm buying for the long term. My rent covers my mortgage, and I'm basically going to sit back and ride the cycles. And ladies and gentlemen, as you know, the last 5 years were very, very kind to me in terms of what happened with capital growth. But, it was the principle of the investment. When there's problems in the market, there's also opportunities. And the most important thing is to focus on those opportunities and to buy properties that are cash flow positive. And as a little anecdote, that property earns me around £2,400 a month. My mortgage a year ago was £1,750 a month. With the interest rates having come down so dramatically and the fact that I'm on a tracker mortgage, my mortgage now is £475 a month. So, I mean, you really want to understand what a benefit it is from a cash flow positive perspective and again, taking advantage of the market. When I mentioned cash flow, the most important thing for me when investing in London is buying in an area where you're going to get tenants. I have a rule of 10 minutes. I don't want to be more than 10 minutes from a tube station because tenants don't want to walk. Now, when one looks at the London market in terms of the rental demand, and it's the thing that concerned me the most because, the one thing I've always said about London is that if you buy in the right area, close to a tube and everything else, you'll never have a problem with tenants. Obviously, with the retrenchments, it was something of a concern of mine, and it was the reason that I flew over to go and do the research. And basically, on the whole, I spoke to 5 different management agents that I've worked with for a number of years. They said to me, rents aren't really rising. They're remaining pretty stable. In some areas, they're coming down. It all depends on location, and you really need to be focusing on the areas, the good areas, and also you don't want to be trying to rent properties for more than £2,000 a month or roughly £400,000 in terms of purchase price, because those are the ones that are struggling because there's not that much demand. If you take London as a whole, the month-on-month rise in asking rents has actually been last month was 0.4%. So, I mean, as I said to you, it's very, very stable in terms of the fluctuation. And, I mean, the average rent now is £1,623 per month. The thing is that despite this little recent growth in rental prices, the London market is still far from making a full recovery. Overall, though, rental prices have fallen on average 6.6% year on year between May 2008 and May 2009. And there's only 3 boroughs in London that have actually shown a positive trend. One of them is Barking and Dagenham, the other one is Hillingdon, and the other one is Greenwich. And ladies and gentlemen, this is from Find a Property, which is one of the biggest rental portals in the UK. It's no coincidence that IPS is recommending that you invest in Barking and you invest in Greenwich, and it's where we've got 2 projects where we're actually investing at the moment. The average rental yield in London is 4.74%, and investors are getting better returns in the outer boroughs. So again, that's coming back to the secondary market, in terms of you're getting better returns in the secondary markets than you are in the primary. And, to give you an example, Barking, which is where we're recommending at the moment, it's actually getting the best yields anywhere in London, and that's at 6.44%. But when you look at the other side of the coin, it's the really primary markets, the Kensington and Chelsea's, affluent areas like Richmond and Wandsworth, where you're getting the lowest rental yields. And they've actually, the average yield now is around 3.92%. And it just shows you, the difference between the primary and secondary areas and why we like to focus so heavily on these secondary areas. In terms of overseas property investors, there's been a big increase recently in demand for London property from overseas investors, primarily from Hong Kong and South Africa. And the reason being is that the currency is weak, the pound is weak, and therefore you're getting good value for your money. And secondly is that obviously the value of the assets is very good. And most investors are looking at it with a medium to long-term view and from an income perspective and saying that now is a great time to be looking. And because of that, over a third of transactions in the last 3 months have been from international investors, a number who have come through us with regards to South African investors. As a South African, we also need to understand something very interesting. If you take the last 15 years, okay, there's been 400% growth in South Africa and there's been 182% growth in the UK. If you'd invested exactly the same amount of money in South Africa in 15 years ago, or if you'd invested the exact same amount of money in the UK Today, taking into account all the variables, you would actually have 240% more money in the if you invest in the UK than if you invest in South Africa. And that for me is one of the most critical components for someone to actually understand in terms of why someone should be looking to invest offshore. I want to run through a spreadsheet quickly. I'm just going to change the screen here to the spreadsheet. This here is a cash flow. Now, for those of you on the telephone, I will email this through to you, but the important thing is just understanding the underlying variables. In the first box, you've effectively got the variables. I tend to work on a 70% loan to value. It is tricky getting mortgages in the UK at the moment, but we are still getting our clients 70% for people living overseas. The rental, you've got the rental yields, you've got the gross yield there, you've got rental escalation around 2%. Even though the Bank of England rate is 0.5%, you're actually borrowing in and around the 4% mark. And for a 2-bedroom, 2-bathroom flat in London, I just took an average one at £315,000. We do have property that's as cheap as around the £136,000 mark. So, I'm just trying to give you an example. The right-hand side is the stamp duty. You need to, if you rent out in London, it needs to come fully furnished, so there's an amount there for furniture. You've got the finance, which is the bank initiation fees. There's legal fees. Now, the beauty in the UK is that you've got a lawyer that acts on behalf of the buyer and a lawyer that acts on behalf of the seller. So your lawyer is there to protect you and to make sure that he's done all his due diligence, and you pay him for that. The service charge is like our body corporate rates. The ground rent is effectively what you pay in terms of the rental on the land of the property. And then you've got the lettings and management charge at 12%. And I worked on an exchange rate of 15 Rand to the pound. I know it's a lot stronger at the moment. It's around 13 Rand to the pound. But I tend to prefer working on averages. And over the last 12 months, it's been around 15. The next box gives you a breakdown of the costs. So you can see exactly the amount of pounds that you would need to purchase this property. The only one I haven't explained is the completion cost. That's not any amount of money. That's not being paid to anyone. I just like people to have money in their bank account when they get started. In terms of the cash flows, there's different types of properties. We've got properties that are ready right now. So, I mean, literally in the next 2 to 3 months, if you bought it, you would own it, you would have a tenant in it, and the tenant would be paying you rent. We've also got properties like the one in Greenwich, where it's going to be built over the next 2 years, and it's much easier from a cash flow point of view because you only need to put down 2.5% in the next 4 weeks, 2.5% in the next 6 months, and 5% in the next 12 months. So you're putting down a 10% deposit, but over the next 12 months, it's then going to take another year for the thing to be finished. So it'll be finished in the middle of 2011, and then there's a rental guarantee for a year, taking you right through to the middle of 2012, which is a very significant year for 2 reasons. One is that that's when they believe the market will be fully recovered, and it's also the Olympic year. So it just gives you an idea of how the cash flow works. Very importantly, you'll see that this property is very cash flow positive. It's making you over £5,000 a year on your income minus all your expenses. So, I mean, that's a great, perspective to take into account. And these rentals are also, I always tend to work on conservative bases. And then lastly, in terms of the growth, I don't have a crystal ball better than anyone else. I've taken a 4-year view, and I've worked on 3, 6, and 9. The reason being is that 3% is the average inflation, and property tends to track inflation. 9% is actually the 50-year average, and 6% is somewhere in the middle. So it just gives you an idea. You could even go up to 12%, which has actually been the 10-year average. But I think the important thing there is that you can see the growth that one is getting. And as a South African, the most important thing is that the last box, the rand is devalued by 5% year on year, every, roughly if you take it over the last 15 years. And you need to put that on. So even at a 3% capital growth over 4 years, your rand investment is making you in the region of around, is making in the region of around 24% year on year. And that is very, very important. That's minimal growth over the next 4 to 5 years. But as a rand investor, it shows you the return on investment that you can get. And I think it's important to take into account. So the next, this is quite a complicated spreadsheet, and I'm not going to go into in detail. It's one that I use with regards to my property portfolio. But the most important thing for me in the UK is buying one property, getting it cash flow positive, and then as soon as possible after that, starting to build momentum and to buy your second and your third property and to build a fantastic passive income base, which is what's possible in the UK in terms of that. And what better than to live in South Africa and to own a foreign asset with a foreign first world currency income that's cash flow positive. And my view, taking back to that first house I bought in 2002, if it's cash flow positive, even if the market was to drop another 5, 10, 15%, I will ride out the market because I'm getting fantastic opportunities. And, I believe the only time you can call the bottom of the market is in hindsight. And there certainly are green shoots starting to come through. I'm not saying we've reached the bottom of the market, but the problem is once we realize we've reached the bottom of the market, it'll also be too late to really take advantage of some of the opportunities that are available. I mean, to give you an example, this particular building here, City Peninsula, this building, the developer basically in 2007 wanted to sell it for £650 a square foot. And that's what they had to charge because the landowner was charging them a lot more. Because of what happened in the last 12 months, they were actually able to renegotiate that and bring it to market at £496 a square foot, which represents a discount of around 26%. And that gives you an example of the type of thing and how one can negotiate with developers. And, if we go back to how I started right in the beginning in terms of the amount that the property market's dropped, if we say conservatively the market's dropped in the region of 15%, if you're buying anything with 25% and more discount, you've already built yourself in a great buffer. You're taking advantage of the opportunities that are available, and then you really need to focus on the income component of that property and make sure that the rent is covering the mortgage, and then you can ride it out. And in 2-3 years' time, when the market has recovered, when the banks are really lending, you're going to look back and you're going to wonder how you managed to get an asset at such a good value, basically. As I mentioned on this project, the one thing that's nice about it is that it's actually only starting construction next month in July. It's going to take 2 years to build it, and then there's a rental guarantee for another year. So the beauty here is that it's very easy from a cash flow point of view to secure the unit, taking into account everything that's happened in the market, but actually only have to properly pay for it in 2 years' time. And that just gives you an example. And then, I mentioned Barking. Sorry, that first one was in Greenwich and the Greenwich Peninsula. And as I said, there's over £10 billion worth of infrastructure and development going into the area. But most importantly for me is that it's walking distance to a tube station, and it's one stop from the tube station to Canary Wharf. And Canary Wharf is the financial capital of London, the financial capital of Europe, and arguably the financial capital of the world. And yes, it has struggled with what's happened in the last 6 to 12 months, but it will recover. And the beauty with regards to this project is that it actually has got 2 years until it actually comes to market, and it's got that rental guarantee. And when it recovers, this will be a fantastic opportunity right on the Thames with views up and down the river. Something that's a lot more affordable. It's in Zone 4 in the northeast part of London in an area called Barking. It's very near the Olympic, the stadium, the Olympic City for the London Olympics. But the most important thing here is that this development is actually right in the town centre. It's literally a couple of 100 meters from the tube station. And these units, there's very good demand. And as I showed to you earlier, the Barking is actually the best performing suburb in the whole of London in terms of rental demand, growth and yields. But also in terms of value, these units were being sold a year ago. So an exact unit a year ago was being sold for a one-bedroom unit for £197,000, okay? And you can now pick up that unit now for £146,000. A two-bedroom unit was being sold for £239,000. You can now buy that for £169,000. So, I mean, that's representing a discount in the region of 35 to 41%. And also, the project's there, you can see it, it's got all the pictures. So, it gives you a great opportunity to invest in something that's affordable, in a high-growth area, a high-yielding area, and yet you've got great discounts which represent what's happened in the market. And even if the market was to drop another 10% to 25%, you're still buying it off a very low base, which allows for great growth opportunity in the future. In terms of how it actually works, in terms of financing and structuring, we can help you with the whole process. We've got guys that specialize in helping South Africans get mortgages. We've got a gentleman that can help you with your tax and offshore structures. Some people like to go through offshore structures, particularly if they're buying more than one property, because there are benefits from an income, capital gains, and inheritance tax perspective. The process is fairly simple. You basically need to meet with me or one of my team and understand what you're doing. You then ultimately choose a property. You put down a 20,000 Rand reservation deposit, and at that point, we actually go out and we get all your exchange control approvals and everything else, and that 20,000 Rand is refundable should that not go through. Once that's in place, the first initial deposit, depends on different properties, will be 2.5% on the one and 10% on the other. Will go through to your lawyer. Again, it's a lawyer that's been working in South Africa for a long time. He's helped over 1,000 South Africans invest in UK property, so fully understands the process. And he will then exchange the property for you, at which point it becomes legally yours. And then depending on the different property, we will help you manage it through to completion. We've also got a guy that can help with regards to foreign exchange and moving money over to the UK. And ultimately, we from IPS, International Property Solutions, we provide you with an end-to-end solution. We've got management agents on the ground there to make sure that your unit is managed, maintained, and looked after, so that, really for you, you can have a peace of mind that you're looking at the investment, you're looking at the income and the yields, but you're not having to worry about whether the tap's leaking. And ultimately, what we try and do is provide you and help you and make sure that you can invest with confidence. The type of things that we can assist you with, we've got quite an array of different product offerings in the UK. As I said to you, we've got a number of different investment apartments that you can invest in, both stuff that's ready now, plus also stuff with longer lead times, but most importantly, stuff that takes into account what's happened over the last 12 months. We can help people find individual homes. We can find repossessed homes. We can also find homes which need renovation and then help with regards to the management of that renovation. And also for some people, we can negotiate bulk discounts. So for example, where they want to go in and buy an entire block with 8 units. And we've got one of those at the moment in North London. And then finally, I've also got a South African gentleman that specializes in commercial opportunities and again can go out and source commercial opportunities in London. So that pretty much brings me to conclusion. There's a saying in South Africa, "Fair van jou goed, na aan jou skade." I'm a Durban boy, so please forgive me for my pronunciation. But basically it means, South Africans are nervous to invest, away from, being close to them, etc., because can they control it? And I think what one needs to understand is, firstly, the huge opportunities that are available overseas at the moment, particularly with a strong rand, but also that it's very, very important and I believe very prudent to live in Africa and to own offshore assets and to have a foreign income. And the important thing is that IPS provides you with a solution to enable and facilitate that. I asked you the question right up front, why I think it's the best time since 1991. The market is expected, according to the Knight Frank report, which came out recently, and they're one of the most respected property experts in the UK market, they're expected to have fully recovered by 2012. And the most important reason is because of the fundamentals that are in place. And really it's a case of getting the banks to lend again. And that is going to happen in the next 6 to 12 months. They're really working now with the government and the banks to let the man in the street be able to borrow money again at reasonable 90, 95% loan to values. And when that happens, the wheels of the property market will start to turn. The second major reason is that there's great asset values at the moment. There's fantastic opportunities to buy at very good discounts because you're buying off motivated sellers, and that is the best way to make money in property. And the third reason is the strong, strong value of the rand. In 2008, for the last 12 months, the rand is valued in and around 15 Rand to the pound. It's now at 13 Rand to the pound, and it's very, very strong. And what concerns me is that in a recent report that came out from R&B, they actually said that they believe that with regards to the South African exchange rate, that they're expecting the US dollar to South African rand to be between about 9 Rand to the US dollar and to be around 10 Rand by the end of 2010. So, we're currently at around 8 Rand. They actually say that the rand is actually overvalued at the moment. And the final thing that this R&B report said last week was that if you're looking to invest offshore, now is the perfect time to do it. And it's the complete opposite of a perfect storm. It's the perfect day because you've got low asset values and you've got a strong rand, which really enables you to get into the market and take opportunities. So I'm going to finish off with this little saying by by Van Gogh, which I love. It's whatever you do or dream you can, begin it. Boldness has genius and power and magic in it. Begin it now. And, you know, I go back to my own personal example. I was terrified in 2002 when I bought my first property. Everyone was telling me all the negativity. As I said, we just had September the 11th. But I looked at the fundamentals. I focused on the property and the investment cash flow of that property, and I've never looked back with regards to the benefits, because the cash flow was positive, and you know, whether the property market went up or down, I was in it for the long run. I think the important thing as well is that, just to finish off, is if anyone's got any questions, for those of you on the telephone, please just fire away. For those of you that are actually online, if you could just, you know, write a question and send it through to me, I'll be able to answer them. And we are giving away 2 tickets to the British Lions versus the Springboks at Ellis Park on July the 4th. And what I would suggest you do is everything that I've spoken about is actually on our website, ipsinvest.com. And the nice thing is if you go on there, there's a hell of a lot of information about investing in the UK, what's happening in the market. There's frequently asked questions, there's videos that I've made when I've been over to the UK, and obviously there's the opportunities. At the moment, the Barking one is not there yet. We're just finalizing the final agreements with the developer, and I'm waiting for the final developments. We've been very aggressive with the prices, but there are other projects there, and it can give you a full overview of what's actually happening in the market. So from that perspective, if someone could give me an idea, are there any questions, anything that I haven't covered? For those of you on the telephone, is there anything from your side that I can help with? Okay, guys. Well, I don't. I mean, I'm sitting here online, and I don't see any questions coming through. I presume then that we effectively have answered all the questions and hopefully given you a full overview. You know, when I set out today, the intention was really to provide you with an understanding of the UK market, understanding whether, you know, there's crisis or whether there's opportunity, or actually, in my opinion, there's both. And hopefully I've been able to give you that overview. Hopefully you've got a far better understanding of the market. I would highly recommend going to our website, ipsinvest.com. There's a lot of information there. But, you know, when you're ready, then you really want to get hold of me or one of my team, and we can actually help you. We can understand what it is you're looking for, and we can provide you with a solution. So I want to thank you all very much for your time this morning, and I look forward to helping you in the future. And if there's any questions you've got, I will send you an email now to follow up. And for those of you on the telephone, if you want to send anything through to me, my email address is scott, SCOTT, @ipsinvest.com. So I look forward to hearing from you. Have a great weekend, and thanks so much for your time. Cheers.